Now to markets, which are turning lower today with the Nasdaq leading the decline. They're still on pace for their best month since January, the Nasdaq is, while the Dow and S&P are tracking for their biggest monthly gains since last October. And my next guest says the technicals point to continued strength from here. Jeff Krumpelman joins me now. He's chief investment strategist at Mariner Wealth Advisors. Jeff, it's good to see you. And a lot has been made of the breadth of the recent rally. What does it say to you? Just give us the facts.
Well, I think that we've got a lot to be thankful for going into Thanksgiving and this holiday. And, going back into October, the opposite mood was developing as we had all these geopolitical events that were going on. People were worried about not being able to name a Speaker of the House. And folks were really getting nervous about rising 10-year yields as we were. And a lot of the purely economic factors, I think, have moved in a good direction. Yields have backed off significantly, which is a really big deal. That's the biggest risk that we were concerned about, rising yields. And as a result, the technicals, as buying has come into the market, you've seen the percentage of stocks trading above the 10-day moving average or above the 50-day moving average move from about 10% to 70%. And somewhere around 20% on 200-day moving average, we're trading above the 200-day moving average, now about 50% plus. And we've just had a really nice rally. It's broadened. You've gotten value outperforming growth, equal weight outperforming, the market cap weight, non-mega 8 stocks really moving in a nice direction, small cap over large. And so is that a real sign that, we're out of the woods? Probably not, but it's something that you need to see that could signal that. And we certainly have maintained positive S&P 500 price levels going through mid next year. So it's a good sign for us.
Where in particular, you often do a lot of stock-specific kinds of things. Where do you think are the biggest valuation opportunities for the run that you are anticipating?
So, we've felt, if you go back in that 2007 to kind of 2020, 21 period where we had zero interest rates, being a portfolio manager in an active strategy, you're kind of a dinosaur, or you began to worry about that. So active management's come back, and we think that there are opportunities both in the growth sphere and in the value sphere. So we have a barbell, if you will, in a way, in that we see attractive non-mega 8 valuation within technology and consumer discretionary in those growth names. We also find them in the cyclicals as we have a capital spending boom going on. So we're doing a little bit of both, boring industrial, cap equipment oriented, some go-go growth in consumer, and some tech. So we like those areas.
Boring industrial and go-go consumer is pretty much a synopsis of the economy right now. Are you worried about some of the retail mines we seem to be hitting as we move through this earnings season?
Well, again, I think where it goes back to active management, know what you own and be selective. So, when you look within consumer, it really is the experience area. So I would highlight before going to retail, I would own things like Bookings and Royal Caribbean, as we've talked about in the past. But within retail, there are stocks like Deckers, for example, a shoe company, Uggs and Hoka's. It's cool to wear Hoka's, and you're just seeing really strong uptake. So it depends upon the product, your merchandising capability, and where you're at. So there are some areas to avoid, but there certainly doesn't mean the consumer's dead. You can do very well whether in experience or in, I think, the goods category if you're positioned well.